All right, let's talk about taxes for a minute. The MLG funds generally send you a K-1 each year, and that passes through depreciation to the investors, obviously. But you also have another option. Tell us about that other option with the MLG funds.
We do, yeah. And that's another differentiator for us. We have two different vehicles by which you can enter Fund 6. You're invested in all of the same properties. You're expecting the same pre-tax returns. The difference really lies in how the tax or the income that you realize is characterized from a tax perspective. The first one, like Jim just mentioned, is a traditional LLC structure. It's all a pass-through, massive depreciation expense being passed through to investors. We have a unique secondary structure that we call our dividend fund. If you can picture it, we own the properties, cash flows from the properties up into a non-traded private REIT vehicle, and then from there to investors. All that does is it reclassifies the income that you realize from passive rental income to dividend income, which has two primary benefits. One, if you're looking to invest through a retirement account vehicle, you can do so without triggering unrelated business taxable income, or UBIT, for those familiar with the issue. In layman's terms, it avoids any additional taxes being levied against your retirement account income. That's a really powerful benefit of this structure, very well set up for 401k and IRA investments. But also, people will just put after-tax dollars, cash into the dividend fund to avoid the multi-state filing potential that exists on the main fund side. The trade-off there is those losses that are produced from massive depreciation at the properties are trapped at the REIT entity level. Even if you invest cash into the dividend fund, you still have a very tax-efficient investment as it specifically relates to your investment with MLG. But what you lose is a passive loss that flows through to you that can be used to offset other passive income from other investments that you may have. So smaller dollar investors generally tend to be a better fit for the dividend fund. If you're thinking of a longer term, larger investment, then the private fund or the other side of it might be a better fit for you.
I suspect as a REIT, the dividend fund would also qualify for the 199A deduction with its income.
That's correct. Now, the goal in the dividend fund, similar to the private fund, is to produce minimal, if any, ordinary income. The goal would be that the REIT is using those losses to offset any distributions at the REIT level, and then we're only paying or realizing any taxable income when we sell, and it's capital gain taxes that we would owe. But you're right. To the extent that there is any ordinary dividend income produced, it would be eligible for that qualified business dividend deduction.
Now, if you're in the traditional LLC that sends out the K-1, how many states does MLG 6 invest in now, and do you expect that to increase?
We are in 7 states as of now, I believe, 3 of which are Texas, Florida, and Tennessee, which don't have state income tax. I would expect we'd be in 12 to 14 states when it's all said and done, plus or minus. So you're probably looking at 8 to 10 different states you need to potentially file taxes in. For those that have significant passive ordinary income, the savings that can be produced by using our losses to offset and defer that income can be very, very powerful. But it's not for everybody. There definitely will be an impact to your tax prep cost. So it's worth consulting your CPA, both to see what it will cost you and also how those losses could potentially benefit you.
Will MLG file composite returns in the states that allow those?
We do not. There's some limitations in the carry forward ability and deposit returns, and with investors coming in at such different times throughout the fund, it just ends up not actually being as much of a net benefit as it might seem like. So we do not.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.